Hey everyone, I recently had the pleasure to sit down with one of the foremost gold experts, Alasdair Macleod, and a good colleague and investment expert of mine, James Breiding, to discuss the topic of gold and why there are so many structural tailwinds now, maybe more than ever. And I really enjoyed sitting down with them. It was a pleasure and an honor to be able to discuss the topic, which is so current and topical right now for many investment professionals and also self-directed investors at home. Unfortunately, when we first edited the podcast interview, we encountered some editing issues with the software we used, and so it made the audio and visual quality not as good as we'd like. I'm pleased to announce that we've re-edited it and we are putting it back up again right now. So it's going to be a wonderful listen to. Now, when you listen to this interview, there are some really thought-provoking and crucial points that are being made by Alasdair and questions asked by James that I think are not being discussed mainstream. And so without any further ado, please go ahead and watch the podcast. Hey everybody, Serge Berger here. Welcome back for another podcast. This is a very special episode because I'm doing this in conjunction with a good friend of mine, James from Naissance Capital, based out of Zurich, Switzerland. James, how are you?
Great to be here, Serge.
Great to have you here. This is the first time in the office. He's, I think, already met our friend up there. We are going to be talking about gold today. This is a topic that I have continuously talked to our distribution, our client list for, years and years, and becoming more and more convinced of it in this current juncture, at this should say about nine-ish months ago, for various factors I'm sure we might be able to touch on. And it is my great pleasure to introduce to you Alasdair Macleod. He is an absolute expert on the topic, which is why I'm so happy to have him here. He is, let's see here, the credentials are long and awesome. He is the author of all sorts of research pieces. He's an evangelist on the whole topic, and also the head of research at GoldMoney Inc. Alasdair, welcome to the podcast.
That's very much my pleasure. Thank you for having me.
Thanks for being here. So I guess we'll just start off with a very simple and obvious open volley. How do you see the gold market here? What's going on in your mind?
Well, I think the first thing, first point I must make is that it's not so much gold rising as paper currencies losing their purchasing power. And I think that's a very important point to understand. And this is particularly understood by foreigners, if I can sort of, put everybody in that category who actually does understand this. And I'm particularly referring to Asians, Chinese, maybe even some Indians, who actually realize that gold is real money to them anyway. The paper is just something transient. So, is the fiat currencies going down? That's the background to what we're seeing. And it's actually getting quite serious. I mean, the thing that's so interesting is that people in the Western Alliance, which, if I can call them that, let's call it the currency alliance, dollars, euros, sterling, yen, whatever, they don't understand this at all. The moment they do, then according to economic theory, basically the currencies are dead. They've had it. So that's the journey, the end of the journey in which we have started. But the people who do understand this, of course, are foreigners, because foreigners either own or are being asked to own paper currencies which are not currencies which they use day to day. They are someone else's credit, in effect. And so they take a very different view of these things. And what we're seeing, I think the People's Bank of China is a very good example. What the People's Bank of China have been doing is they've been selling dollars. But what do they sell the dollars for? Other currencies? Well, no, the dollar is the top currency. They sell it for real money, which is gold. And so, when you grasp the concept that actually what the Bank of China is doing is selling dollars, not not buying gold as such, the emphasis being on selling dollar, then you understand what's driving the gold market. And
So,
it goes
Alistair,
a bit,
just a
yeah.
quick question. Do you think, I mean, of course, the central bank buying of gold has been a big element in this sort of rise of interest over the last 9 months. How much of that do you think is a function of the fact that the Americans have chosen to weaponize, let's say, capital markets, vis-a-vis, for example, Russia, versus a sort of flaw in the fiat currency argument that you've been very good at describing?
Yeah, James, it's definitely a trigger. Let's put it that way. I mean, it's woken up quite a few people. I I wouldn't say it's woken up people in the central banks as such, because I think central banks have taken this view that the dollar is less useful than it has been. It is being sold by foreigners generally. And if you look at the Shanghai Cooperation Organization and BRICS Plus and all the rest of it, you can see that the policy basically is to do away with dollars as much as possible. So this is something which, from the central bank's point of view, they need to adjust their reserves to take account of this. So they are selling dollars, they're selling euros, and they are buying gold. But if you're a central banker in a foreign central bank, yes, I mean, you look at this and you think, what they've done with Russia, well, that's not anything terribly new. The Americans behave like this anyway. But it does reinforce the point that the dollar can be used as a weapon, as an economic weapon, and the Americans have no hesitation in doing so if the circumstances permit. For anyone thinking of joining BRICS, one of the threats they face is American provocation. Whether it's weaponizing the dollar or by engineering a coup d'état, which apparently the Americans do. I'm not making any accusations. You can see that this is, I mean, all these factors feed into it, but it boils down to the same thing. They don't want dollars. I mean, it's not that so much, and this is the point I'm trying to make. It's not so much they're buying gold; they're trying to get out of dollars. They're trying to get out of anything that is related to dollars, which basically is the whole of the fiat currency system. And
is there any evidence that this behavioral pattern is being mimicked by, say, other central banks like Japan or the Middle East? Is there any evidence to describe, any evidence to support that yet, or do you anticipate maybe that taking hold?
Well, this is the fascinating thing, because the point about the Western Alliance is the Western Alliance, which is sort of embraced wholeheartedly that the dollar has replaced gold entirely, and gold is now just a pet rock. I mean, they've all bought into this. Have you just look at the policies of the Bank of Japan. They are thoroughly Keynesian in their approach. They don't realize what is actually happening to their own currencies. They don't see the danger. It's just like the people who are last to understand it are the people who actually use the currencies for day-to-day transactions. They will eventually wake up to what the foreigners have already woken up to and already decided that they don't want to have a part of. I mean, so I think our central banks are yet to go onto that journey. Now, having said that, the few central bankers that I've talked to, they don't dismiss my argument. I think it causes them pause for thought, but I don't think they've got to the point where they really begin to understand it. Because apart from anything else, from their point of view, it's a horrific conclusion. It really is. It means, and particularly for America, the Americans, so far as I can see, do not have the gold which they claim to have. Now, I think the evidence of this we saw in their treatment of Germany when Germany wanted a small part of her gold repatriated. And not only that, but if you go back to the last century, when gold was used, if you like, it was leased, as it were, as part of the as an arrangement whereby you could lease gold at 1.5–2%, and then sell it into the market and go and buy 6 month treasuries at T-bills rather at something like 6%, 7%, 8% yield. I mean, we're going back into the mid 80s and into the early 90s. So that carry trade, that was the original carry trade. And of course, this gold disappeared. And as an analyst called Frank Veneroso put it in Lima in the year 2002, he'd done a lot of research on this gold leasing thing. He reckoned up to 10 to 15,000 tons of this gold had been leased out from central banks and had disappeared, effectively being worn, as he put it, around the necks, as ornamentation of Asian ladies. So, there is this huge, great hole in central bank numbers, gold holdings. And looking at it, I can only conclude that that big hole is actually in the US holdings. The US holdings not only of its own gold, but also the earmarked gold held on behalf of other central banks. So I think the whole of our system doesn't understand this at all. And also, if you talk to people, members of the London Bullion Market Association, the people who are on the short side in COMEX, they don't really realize this either, because they've made their living out of trading something which, wasn't really going up in value, or it might go up in value, but it would come down in value. They could manipulate it. But this is now changing. This is the whole thing. And if I can just give you another example of where this is really going, look at it from the point of view of the Chinese savers. Now, Chinese savers fully amount to something like 35% of China's GDP. I'm talking about household savers. These are the individuals, if you like. Now, that's the equivalent of $6 trillion. Now, where does it go? It's no longer going into property. The stock market is not attractive. Yeah, the stock market's not attractive. And they can't put it into anything abroad, really. So what do? I mean, at the moment, it's all on bank deposit. But the banks do offer, and this was something which was promoted by the government. They instructed the banks, in effect, to do this, to offer gold accounts. So if you've got a minimum of, say, 500 or 600 yuan, you can open a gold account at your bank so that you can have some of your money, say, on deposit and some of your money invested in gold. Now, if I can just sort of say, without all those alternatives, I mean, the property market's had it and so on and so forth, we're looking at the equivalent of 75 trillion tons of gold in savings every year. Now, obviously, I wouldn't say that. I mean, for a start, there isn't 75,000 tons of gold available for this to meet any sort of demand like that. But you can see that the pressure for investing in gold, and also silver, incidentally, just from Chinese citizens, is really ramping up. And I think...
So really, you're saying it's a Chinese tsunami at both the retail and the central banking level, which will be driving demand.
Absolutely.
Because I was, in preparation for this discussion, I looked at net inflows, outflows of ETFs, the sort of Western capital markets, and I was actually surprised that despite net outflows, I mean, we've had 11 quarters of outflows up until May. Now, for the last 2 months, we've had inflows, so it seems like it's turning. But this price rise that we experienced over the last 7-8 months has been really, despite the fact that there's been net outflows of ETFs. Does that surprise you, or just to give you a sense of how much demand must be compensating for these negative forces?
Yeah, well, when I sort of think it through in terms of this sort of foreign approach to investment or credit risk, and domestic views of credit risk, and then transfer that onto the sort of Western alliance versus the huge great Asian hegemon bloc and all the rest of it, we can find. I mean, the three of us are experienced in financial markets and in investment. Okay. This sort of behavior we're getting in ETFs is the sort of behavior you get at the bottom of a bear market. This is the last gasp, basically. The unwashed public basically selling out, having lost loads and loads of dosh. But here we are seeing exactly the same phenomenon, right? When prices are going into new highs. At some stage, this sentiment is going to turn round. And it'll turn round when people begin to realize that perhaps it's not prices of goods and services rising, but perhaps my money's going down. By money, I mean credit, the currency. And the moment they start latching onto that, they begin to understand a little bit about why gold and silver are rising. And also, of course, they will be attracted by the only bull market in town, because part of the whole scenario, which is evolving, is that if you've got people in the Asian block, as it were, turning sellers of US treasuries, then the yield curve is going to go sharply positive. And goodness knows what sort of level of yield the US government is going to be financing its deficit, which incidentally will be considerably larger than the Congressional Budget Office tells us. So, if you put all these things together, you can see that the market shifts are going to be very, very remarkable. I mean, higher bond yields means nasty bear market in equities. It means there's going to be a rotation out of anything which they've made money in so far, which will suddenly turn quite sharply into loss making, into mines, minerals, oils, whatever, the whole of the mining complex is suddenly going to get terribly interesting. And there's not a lot of stock around. I mean, you've got a few leading companies, which obviously the investment management industry can buy quite easily because they don't have to think about it too hard. But where are the analysts? Where's the information? This is going to be a fascinating shift. And I think anyone who is late in that one is going to rather regret it.
Well, it's interesting, Alasdair. You this is a timing question now. I was just watching a popular financial television station the other day, and the lead analyst was talking about how at some point they're going to really quickly change all their portfolios, and we're talking about many hundreds of billions of dollars, and I just couldn't help but laugh. It's not going to happen. Let me just quickly give people a little bit of graphics here. First of all, I mean, I think that point that Alasdair made here about it's not so much, in this case, China, let's say, buying gold, but they're really selling dollars. I think that's right there. That's a great headline. Also, just a little bit of visuals here. I brought along a few charts. What we're looking at here is a long-term chart of the gold futures market. You can label this spot; it doesn't matter. It goes back to just a couple of years before I was born, so it's been around for a while. And essentially, what we're seeing, this is a logarithmic chart. You can essentially see, gold had that big run that I certainly remember up to 2011, and then basically did nothing for a long time and has now started to break out. This is where we now have this performance year to date. I just brought along the popular SPY S&P 500 tracker. Essentially, gold actually was outperforming the SPY up until a few days ago, and then of course Apple and Nvidia is doing things again. Last point I wanted to just quickly make, which I thought is fascinating, you just mentioned gold is behaving right now like it would at some sort of horrible bear market in risk assets. At the same time, where risk assets, at least a few of them, are basically going parabolic. So I just find that really fascinating. I don't know if you guys have any thoughts on this, but to me, it's all kind of lopsided, at least for a while.
It's completely lopsided. And I mean, also, if you look at the bond markets, that's very lopsided. The markets are basically broken. I mean, we're facing an election in this country, which is going to elect a left-wing socialist government, which will be high spending. This is not going to be a surprise for anyone. Yet, as far as the markets are concerned, the yield in the gilt market on the 10-year gilts is lower than on US treasuries. Now, hold on. The risk default in global bond markets is US treasuries. Why are we yielding less than US treasuries when plainly sterling is going to collapse on this election? It's a complete nonsense. And it's not just there. I mean, if you look at some of the yields around the Eurozone, I mean, there's a complete distortion when you look at, say, Greek bonds, Italian bonds, the yields there. I mean, they're less than U.S. Treasuries in some cases. This is just bizarre. Is a short answer, and that is something that at some stage will correct. And when it does correct, I think it'll be because the markets just go snap. The markets will come back and drive pricing. And in that context, I think the idea that the central banks actually have control over interest rates, you can forget it. That's not going to happen. I'm sure that they're already, there are central bankers worrying about this one way or the other, but everything seems to me to be totally mispriced. It is absolutely crazy.
So I get the central bank and the China tsunami argument. I get the flawed fiat currency argument, which are, by the way, extremely strong arguments. But just to sort of play devil's advocate, if we do have inflation sort of being tamed, which people seem to say it is, and let's say we have higher for longer, so we have higher real rates than we've had historically. Historically, those are not great conditions for gold to outperform. So, what do you say to those devil's advocates?
And I'll bring up the real rate here. I'm just taking 10-year treasuries. It's I think this is the constant maturity one, subtracting 10-year break-evens. So that'll give us that real rate.
Well, the origin of inflation is basically government money printing, more so than bank credit. I mean, bank credit misdirected is inflationary as well. And by that, I mean bank credit which is expanded to finance consumption as opposed to production. That is inflationary. The Biden administration and Mr. Trump's administration, when he becomes president, if that's what happens, it's going to be no different. They're going to be running larger and larger budget deficits. And so far, we haven't even taken any account for an economy which is probably, it's certainly underperforming, and it is probably going to be in the throes of a collapse if certain things happen. Now, under those circumstances, you will get rising prices. And the mistake which analysts tend to make is they think that rising prices require increasing demand. No, it doesn't. What it requires basically is a falling value, purchasing power of the currency. That is what is happening. The extra money that's going into the economy, the extra credit that's going into the economy is purely being produced by the government for non-productive means, and also by the banking industry in the sense that it is allowing savings, if you like, to diminish by increasing credit card debt and all these sort of various means of financing consumption without savings. So this inflation problem is not going to go away. This is a situation which is rather like the 1970s in that sense. And I think that, the debt trap, which is part and parcel of this problem, is going to drive up bond yields on the long end, as I referred to earlier, and it'll drive it up. I mean, we had this situation in the UK back in 1976, when we had to call in the IMF, basically, to rescue the situation. At that time, the government was forced to issue medium and long-term bonds, I think 15-year maturity bonds, with coupons of 15% and more. Now, imagine what that does to, a debt to GDP in the US, government debt to GDP of 130%.
Maybe
This is a very nasty
70s. Just to have a look at that. No, I think it's interesting. We're just looking at the gold price back in the 70s during that interest rate miscarriage period that you mentioned. That it just went hyperbolic.
Yeah, so this goes back to 1975, so a year before you mentioned, Alasdair. But we did have from that point a 300% 90, we can round it up to 400% increase in that period.
There is another aspect of this, which the current crop of investment managers seem to be totally unaware of. They're sort of informed by the carry trade thing, where there was the relationship between the cost of borrowing gold and the return that you could get putting those proceeds into T-bills. Meant that there was a relationship, if you like, developing between the yield on gold and the yield on T-bills. And if the yield on T-bills went up relative to gold, it would increase the selling of gold, basically to increase the carry trade. But actually, if you go back to that period in the 70s and look at the relationship between the gold price and the Fed funds rate or the prime rate, you will see, that decade started with gold around about $35 an ounce. It was officially there anyway. And the Fed funds rate was running at about 6.25%. It did subsequently go down to 3 and change. But, at the end of that decade, we ended up with gold at $850 an ounce and 19% Fed funds rate. So, actually, in normal times, there is a strong correlation between rising interest rates and a rising gold price. And the reason for this is very, very simple. The reason that interest rates have to rise is because the expected fall, if you like, in the purchasing power of the dollar is reflected in increased interest rates. And of course, it's exactly the same thing which drives the gold price. So you can see that actually the correlation should be 1-to-1. And indeed it was in the 70s. Mm. And it's interesting that in the last few months, when gold has been running up into new high ground, or as I would put it, the dollar has been going down against gold, you've seen that relation begin to creep back in. And I think this should be noted as a pretty good warning of what's going to come.
And this is the chart that, just to quickly clarify this in case anyone isn't aware of this, what we're referring to here is that at least for a few decades now been what has been somewhat of an inverse correlation between the price of gold and real interest rates. Real rates are your nominal rates, let's say the 10-year treasury, and you subtract, let's say, the CPI, consumer price index, in this case, taking break-even and forward inflation rates, whatever, same deal. And what Alasdair is saying here is that actually longer term, that correlation is actually positive. Unless I'm totally butchering this, but I think that's what we're saying. And it's actually quite important because these historical, one simple thing I always tell our clients about is if you look at the average age on Wall Street, it's currently somewhere around 36, 37. This current bull market in risk assets is about 15 years old. So you take, let's say, a 37, subtract 15, you get to about 22. What do people do at 22? They graduate university, right? So basically, most people on Wall Street have not experienced what a bear market and maybe what some of these correlations look like. So they're all looking at I was walking around
I agree.
I was walking around a conference in Fort Lauderdale the other day, and you go to the convention booths. I was picking up all these brochures of the ETFs I can understand, but mutual funds, others. Every single one of them went back exactly 14 years in track record. Not one of them went more.
Enough to erase memories.
Enough to erase memories, exactly.
Yeah. So just another anomaly, Alasdair, it doesn't seem like, miners have not behaved very well, and which suggests that the market doesn't seem to believe that gold prices will last. And as far as I can see, they look incredibly cheap, the miners. So I just wanted to get your take on gold miners and whether that could be a way to play this.
Yeah, no, James, I agree. I mean, it comes back to this bit of the market psychology. I mean, in Western capital markets, we're still selling gold because we don't. We're behaving like idiot children at the bottom of a bear market still. And the same obviously applies to the analysis of and weighting, if you like, in portfolios of gold mines. And as I pointed out earlier, that there is also the additional problem that nobody's analysing the sector. I mean, it's who wants to get involved with mining? It's dirty. It's not ESG compliant. I mean, you've got all these things you can throw at it, and it's so much easier
Well,
to go and buy Apple.
I mean, this is a variation of Serge's point, because if you've had 15 years of just awful markets, I mean, who's left in the sector? I mean,
Exactly.
Is there talent in the mining sector? Is there talent in the analyst sector? I mean, it seems to be 15 years of pretty terrible markets. So pretty much cleanse everything.
I know. I mean,
does that make sense?
I think the analysts have retired.
I mean, you're still there.
There are actually, to be fair, there are one or two pretty good guys out there who know what they're doing.
Who are your favorites?
But where they make their money, I mean, I'm thinking about people like Rick Rule and so on. I mean, where they make their money, I think, is, they know the managements, they understand the geology, and they've been at this game for the last, I don't know, in Rick's case, I think good 30, 40 years. And they really know their way around, but anyone else, I mean, forget it. They just don't understand it. They don't know it. It's not their game. And the other thing is, of course, you're not getting the, the big deposits being found anymore. These are, it's all sort of,
which is good for the price, of course.
Yeah. But there will be, I mean, the other thing, talking about the sort of market psychology, the bottom of a market, you always find that as the market begins to recover, M&A activity picks up. And I would expect that to become a real feature in the coming months. I really would.
So maybe that's a sign that we're on the cusp of something, is what you're saying.
I think so, yeah. I think so, yeah. But of course, I mean, there's quite a lot of technical stuff. I mean, when you look at people who, instead of chasing value, are sort of chasing momentum, there will come a point, I suppose, where the momentum boys will start getting excited by the sector. So when it turns around, it could be quite quick.
Do you have how would you recommend investors to play the sector? Do you have some sort of suggestions on between ETFs and physical and miners and royalty companies? You have Well, what are your thoughts on that? And what percent of the NAV should people be thinking about?
Yeah, well, the first thing I should say is that I'm no longer in the business of giving investment advice. So just take this as a generalized opinion. I mean, my experience in the past has been that the first things that will move are the big boys, the big mining conglomerates, simply because any fund manager can buy that. And if it goes wrong, he's not going to get sacked. I mean, if he goes for the real esoteric, exploration stuff or, junior mine, whatever, that goes wrong, he's in trouble. So that I think is the first thing to note. But you will find, I think, quite quickly that as things develop, some of the smarter boys will begin to start analyzing these things. You'll find that they will start looking for prospects which are next to established mines, where they could be takeover prospects for the established miner next door, sort of thing. All this sort of stuff. So I think within the sector, there's going to be quite a lot of developing speculation. But generally, I just look at that psychology. I mean, we know that the psychology is extremely negative at the moment. I mean, people will tell me, and I'm sure they tell you, that, the costs of mining are rising the whole time. Energy costs, because it's all energy intensive, et cetera, that's going up. The cost of permissions, you've got political risk. I mean, there's every reason not to buy. But that will gradually be overcome. And I think that once it gets moving, I think it could actually move quite quickly, because it is the other side of the disinvestment of the things that are falling in the mainstream stocks. Now, mentioning ETFs, I think I would say that the difference between holding bullion and holding an ETF is bullion is owning money, full stop. Owning shares in an ETF is actually owning credit, not owning bullion. That's a very, very important distinction. The way I see currencies developing, personally, I would not hold ETFs. I would actually go for the bullion and coin. You know, I mean,
Right.
if we're talking about practicalities, you know, have some coin as well as bullion stored safely in a proper vault, not held in a bank account or anything like that.
Right.
You know, even if the bank says, okay, we've got it earmarked for you, it's your stuff. You know, the banking system actually can turn around and you will suddenly find that there is confusion over actual ownership. I've seen this before. So stay outside the banking system with your bullion. But you know, when it comes to investment, which was really what we were talking about before, then ETFs are an investment. They are not an escape from credit. You do also have that problem with mines, in a sense, in that any equity is actually a form of credit, because what are you buying? You're buying an income stream. You know, there's a promise of an income stream.
Mm-hmm.
So that in itself is credit. And then there is the other problem, which is that we don't actually have certificated shares anymore, or at least, I mean, you can get it, but you have to insist on it and pay for it. You know, we have rights of entitlement, which basically means we don't actually have, if you like, that credit. We've got an extra layer of credit, as it were, between the mining company and ourselves. And this is the system, you know, the DTCs or whatever, you know, the system which issues the entitlement, but actually physically holds the stock. Now, why is this happening? You know, this is happening because you know, the exchanges have absolutely no capital to deal with a real problem in the markets. If you get multiple counterparty failures, then the exchanges go belly up. I mean, it's as simple as that. So the way in which this is dealt with is they will take everybody's shares on which they've got a certificate of entitlement and use it to protect the system. I'm absolutely clear in my own mind that that is why we have this, you know, Euroclear, and we have the, you know, the DTC system in America and so on and so forth. You know, we don't own the shares anymore. We just have an entitlement. Why? Because they're going to need that collateral in the event of an overall collapse. So I would just say, you know, this is another distinction between an investment, ETF or a mine, and actually physically owning bullion.
What percent of the miners are selling their gold forward? I'm just sort of thinking through if they haven't done that, then, you know, probably the next few quarters should show some pretty robust profits, because the increased price in gold will go right to the bottom line. No, so what's your thinking on that?
Sold it forward for paper credit, sold real money for paper credit.
Well, no, but if the gold price was at whatever $1,800 and they sold it forward at $1,800, they haven't benefited in the price increase.
Well,
whereas if they haven't sold it forward, they could, you know, it would just show up as revenue and profits on their.
Well, I can tell you, James, that if you look at COMEX, which is the only, I mean, you know, we get the CFTC's figures, then we can see that the level of hedging by producers is actually almost at an all-time low, which is fascinating. I mean, they're less than 50,000 contracts, something like 40,000 contracts.
But that speaks well for miners then.
It does. I think part of the reason for this is that from a mine manager's point of view, he is primarily interested in the cash flow, because he's got to buy the energy, he's got to service the equipment, he's got to pay for miners and so on. So he's primarily interested in cash flow. Now, when prices were lower, this basically meant that he would be inclined to sell production forward for a premium, so that he would have that cash flow guaranteed. So that's easy to understand. If you go back to 2011-12, when gold peaked after the great financial crisis at around about $1,900, the level of hedging at that stage was over 200,000 contracts on COMEX. Which is interesting, because compare that with today. The other category which takes a short side on COMEX are the swaps. And the swaps are comprised mostly of bullion bank trading desks. And they're the guys who basically will supply the ever optimistic bulls with paper contracts, futures contracts. And they are now bearing most of this themselves. And this, I think, if we get a further rise in the value of gold measured in declining dollars, this actually could lead to an enormous problem within the bullion banking community. I wouldn't be surprised to see a number of these banks getting themselves into severe difficulties.
Interesting. Well, at the end of the day, what we're really talking about here is an asset class, if you want to call it that, that has kind of been out of favor to some extent, and what you're thinking is that maybe at some point it'll come much more into favor, maybe for forced reasons. For a little bit of context, we talked about there being very few gold analysts left, or maybe very few good ones. Right now the energy market. This is just kind of give people some perspective on this. The energy market, if you look at the S&P 500, is currently it's not even 4% of the S&P. If you could just go back, I just took a couple of decades here. From the 90s, 2006, it really averaged closer to like 10%. So that's like, 2.5 times that. So, I'm just trying to, extrapolate here that things can change dramatically. Conversely, technology has historically actually averaged closer to like a 15%, of an S&P, whereas currently if you do the actual math, it's probably closer to 45, 50 if you jumble it all together. So anyway, just thought I'd quickly point this out as a side note. I think we've gone through a lot here, and at the risk of myself getting a headache because it's so much to comprehend here. Are there any last thoughts, questions from you, James, and of course from our guest, Alasdair?
I think we've covered the bases, and I think I found it very fascinating. And thank you, Alasdair, for your contributions, your wisdom, and I certainly learned a lot. So, very grateful. Yeah.
Very much my pleasure. I mean, we're in the business of educating people. This is why you're doing this podcast, isn't it, Serge? So, and this is also my mission. My self-appointed mission in life, which is why I've set up a Substack, because GoldMoney is great, but it's very much angled at if you like, the wealthy, or people who actually have savings which to put into gold bullion. But there is a far wider audience out there which needs to be informed of these momentous things which are happening. And how it will affect the risk to the value of credit. We're already beginning to see this, and we see the foreigners voting with their feet, driving our credit values down because they're abandoning it. I mean, this is really what the Chinese situation is all about. And these implications.
I have maybe one question I was thinking about was just the whole. The convergence or the potential sort of substitution of crypto versus gold. Do you see people buying? Because quite a lot of the arguments that you suggest are also kind of shared by this crypto market, and I'm just wondering whether you think that could either detract from your argument or maybe capitulate and go towards your argument.
Crypto and gold or silver are two completely different things. I mean, for a start, gold and silver are legally, in common law, virtually everywhere, money, whereas cryptos are not. So crypto doesn't have that status. But there is a more practical problem to consider as well. The first is that the role of gold and silver as money is to allow the value of credit to be attached to it. In a practical modern economy, we don't spend gold and silver. We actually deal in the credit, which is attached by value to gold and silver. So the gold and silver don't circulate. I mean, that just, that's somewhere else. But as long as we can exchange credit for gold and silver, then it is, then it works. It's stable. And so the role of gold and silver, well, particularly gold, let's just concentrate on gold, is to be constant in its purchasing power. You do not get that. Sorry, let me just shut the door for a minute. You do not get that constancy out of a cryptocurrency like Bitcoin, which is designed to be so limited in its quantity that its value should always rise. I mean, this is if it is used as a basis for credit. Now, if you have the value of credit which attached to something like Bitcoin, which rises and rises and rises, then no businessman can actually make any investment plans, which basically means putting down money or credit now in order to produce a profit later. I mean, the investment up front, if you find that you just can't calculate because the value of the of the repayment of your capital which you've borrowed, say
it's exorbitant,
in 5 to 10 years, is just through the roof. So in other words, it is totally impractical. There is, James, also another problem, I think, with cryptocurrencies, and that is a purely legal one in the sense of possession. If let us say someone steals a painting off the wall of your house, and it ends up in the possession of someone else, you can claim it back. And not only that, but you don't have to pay any compensation at all, even though the person who acquired it didn't know it was stolen, and also probably bought it through a reputable auction house. This indeed is what the Jewish families have been doing, recovering stolen property by the Nazis. So, that is quite clear. But the situation with money is completely different. Money is completely fungible. Now, if someone steals your wallet and goes and spends the money in the local shop, you can't go into the local shop and say, "Oi, that's my money, I want it back." You can't do that. Unless, of course, you can establish that the shopkeeper was in on the robbery. So there is this fundamental difference. Now, in the case of Bitcoin, each individual bit of Bitcoin is identified by a blockchain. So this gives a right of possession to each individual bit of Bitcoin, as it were. The blockchain is the thing that makes it more like a work of art than it does of money in this purely technical sense. What this allows is any authority who is chasing, let us say, the proceeds of crime, money laundering, or tax evasion, and feels that they have got a case to recover a certain identified bit of Bitcoin, when they come knocking on your door, you're not going to get any compensation. This is a very, very important point. So I would say that these cryptocurrencies are speculation and no more than that. I mean, I can understand the mathematics behind it. We can all understand that. But at the end of the day, if I'm right and the very existence of credit is threatened, then Bitcoin will disappear with it.
Excellent.
That'll open up a whole nother discussion, maybe another time. Again, very much appreciated, Alasdair. One last very important question for you. You mentioned your Substack. Where can people find you? And if it's too long a link, you can just let me know, and we will, of course, share it with people.
Yep. It's basically you either Google Macleod Finance Substack or alasdairmacleod.substack. Mind you, the spelling of my name is sort of quite Scottish, so you might have to have a couple of cracks at that.
We'll get it straightened out.
Very good.
Thank you.
Thank you so much. Great pleasure. Thank you, James, for being here.
Thank you, Serge. Thank you, Alasdair.
My pleasure, and very nice to see you again, James.
Yeah, likewise. Thank you for contributing.
Thank you.
Bye-bye.